let's take a look at this last widely used ratio. It's called the price-earnings ratio. You'll often hear PE ratio. What that does is measures the growth potential, what the market, the stock market, thinks about the growth potential, the earnings stability, and the quality of management of this company going forward. So price-earnings ratio is giving us kind of a clue as to what the market thinks about the future of this company. It's calculated by taking the market value of the company and dividing it by the net income of the company. So we take a market measure, market value, divided by net income to give us this PE ratio. Again, using our data down here, we calculate in X8, the PE ratio is 11.95. That jumped up in X9 to 19.43. In other words, for every dollar of reported income, the market is valuing that in the stock price 19 times. How's our competitor doing? 22 times. So their PE ratio is higher than the example company here. The market looks at a dollar's worth of their earnings and says, we think the future's so bright for this company, we're going to value that dollar's worth of reported earnings 22 times when it comes to the future. So again, the point of these ratios is to ask yourselves the why question. How did we go from 11.95 up to 19.43? And what's our competitor doing to get a PE ratio of 22.1? That's pretty darn good. That's a quick measure to tell us what does the market think about the future of this company.
A summary of these 6 widely used financial ratios. Debt ratio, total liabilities divided by total assets. What fraction of total financing has been achieved through borrowing? Current ratio, current assets divided by current liabilities is a measure of liquidity. How able is the company to pay its debts in the short term? Return on sales, net income divided by sales. For every $100 of sales, how many dollars of profit are left after you pay all your expenses? Asset turnover, sales divided by assets, a measure of efficiency. For every dollar of assets, how many dollars of sales are you able to generate? Return on equity, or ROE, net income divided by, from the balance sheet, recorded stockholders' equity. For every $100 of shareholder investment, how many dollars of profit do you expect to earn, or do you earn in a given year? That's return on equity, measure of profitability, the return on investment by the shareholders. And finally, PE ratio, this one's a little bit different, so I'll put a line here because it's a ratio of a market number. What are the shares selling for out in the market divided by net income? It reflects expected future earnings growth out in the market. What do investors think about the growth potential of this company? That's what PE ratio tells us.